Well, good morning, everyone, for calling in to Mortgage Monday, May 7th. Today, our topic is the self-employed borrower. And as always, after the presentation, I'll have a Q&A where you can simply just ask your question or type it up on the chat, and I can read it from there. So thank you very much again for calling in, and I'll just start. The self-employed borrower. If you're self-employed, you must meet different requirements than a salaried person to qualify for a mortgage. The rules about how that works were updated in recent months to take an even closer look at your business income. So let's review the rules for self-employed people borrowing for the first time and for those who will be impacted by new rules next time they get a loan. Self-employed borrower basics. Two of the most important things lenders review to qualify you for a mortgage are income and assets, which respectively determine how much monthly payment you can afford and where your down payment is coming from. When it comes to income, self-employed borrowers report income as sole proprietors or owners of entities like corporations, partnerships, or LLCs. As a sole proprietor, you file your self-employed income on an IRS Schedule C, which tracks your income and expenses for a given year. Unlike with salaried employees who get to use their gross income for loan qualifying, sole proprietor borrowers must qualify using their net income from Schedule C. Typically, lenders calculate a 24-month average of net income for sole proprietors, as opposed to sometimes requiring just 1 year from salaried borrowers. And if the most recent Schedule C has lower net income than the previous year, lenders will use worst case income by calculating a 12-month average of the most recent year. If you're self-employed and conduct business via a corporation, partnership, or LLC, the IRS requires these entities to file separate sets of tax returns. If you own 25% or more of the entity, you'll need to provide lenders with these full business tax returns, as well as your personal returns. Just like with Schedule C, lenders will average income for 24 months using 2 years of filed business and personal returns. And if the most recent year is lower, they'll average 12 months of the lower year. Some flexibility with tax returns has recently been added. For self-employed borrowers whose business is at least 5 years old, they may qualify with just 1 year of tax returns. Those returns must show at least 12 months of self-employment income. And that year is the most recent filed year, of course. When it comes to assets, self-employed borrowers sometimes have a lot of their money in their business and may want to use those funds for down payment. Some lenders will let you do this, and if so, they often require that your tax preparer verifies that use of business funds for a home purchase won't have a material impact on the business. New rules for self-employed borrowers. In February 2016, Fannie Mae updated self-employment income calculation guidelines for borrowers who own partnerships and S-corps. These guidelines impose stricter analysis on income and debt trends of a company to determine whether the company has sufficient assets to support the withdrawal of earnings to pay its owners. If you own an entity like this, your income from the entity shows up on a form called Schedule K-1. This form is part of the entity's tax filing, and the figures on this form get carried over to your personal tax return as income. This income most often comes in two main forms: ordinary business income and distributions. New rules for self-employed borrowers now impose conditions on whether you can use either of these forms of income. For example, if distributions are greater than ordinary business income, then ordinary business income may be used to qualify. But if distributions are less than ordinary business income, or distributions don't exist, then there are a host of guidelines to determine how you qualify. These guidelines will be specific to your profile and they will vary by lender. So the best way to determine whether you qualify for a loan as a full or part owner of a corporation or partnership is to find a local lender who can analyze your returns for you. How long must you be self-employed to get a mortgage? You may not have to show a 24-month self-employment history to get a mortgage. For instance, Fannie Mae says you may qualify with 12 months of self-employment if you have previous experience in that field. and your income is at least as much as you earned in that field before becoming self-employed. However, if your loan request is a non-conforming loan, you may be required to show the minimum 24 months of self-employment history. Alternatives for self-employed applicants. Self-employed mortgage loans have gained a reputation of being difficult since the housing downturn. That's because many self-employed borrowers don't show enough income. If the lender's definition of income is the bottom line on your tax return, oh yeah, sorry about that. That's because many self-employed borrowers don't show enough income if the definition of income is the bottom line on your tax return. Self-employed borrowers write off as many expenses as legally possible. That's reasonable because they pay self-employment taxes in addition to regular income tax. However, alternative programs allow you to count all of your business cash flow, the amount you actually bring in, as income. These are often called bank statement programs. Under these guidelines, you bring in 12 or 24 months of your business and or personal bank statements. Lenders analyze the amounts going in each month, average it, and use that amount or some formula based on that amount to come up with qualifying income. Note that these programs usually come with higher mortgage rates. Planning ahead. If you're self-employed and want to buy a home, plan in advance. Work with a mortgage professional and involve your accountant as well. You can change the way you write off your business expenses and the amount of taxable income you show. Alternatively, you can amend previous tax returns to show higher income from the past. Note that some deductions, such as depreciation, won't hurt you. Underwriters add these deductions back into your taxable income. Okay, so that is that's the basics of self-employed borrower information that I have for you today. We can do a Q&A now. If anyone has any questions, you check the chat room, see if anybody has any questions there. Nope. Well, again, if you have any questions later on, if you have a chance to review this on your own and you have a question for me, please feel free to email, call me, text me, and I'm happy to answer any questions you might have. Thank you for calling in today. Our next Mortgage Monday is going to be Monday, May 21st, topic to be announced next week. And thank you for calling in today. Have a great day, everyone. Aloha.